It was a pretty quiet day on Wall Street as the S&P 500 closed up by 0.9% on some renewed optimism of slowly reopening the economy. We also had some earnings news to digest. In that vein, there was some interesting news after the bell tonight. Disney, of course, a very well-known company globally and a member of the Dow Jones Industrial Average, decided that they're going to suspend their dividend. And so they're not the first big company to make that announcement. Of course, Royal Dutch Shell did that here a week or two ago as well. But just goes to show you what type of a market environment we find ourselves in right now in 2020. It's tough times out there for companies that are trying to share some of their distributions with shareholders. So we'll take a look at the market bounce here today, see what it means for our posture. Then for our trade application example, I wanted to focus on a theme that I've brought up countless times in these videos in recent months, but I want to add some additional exposure to it. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 5th, 2020. Happy Cinco de Mayo to everybody. Remember that if you are new, make sure you go over on to our YouTube channel, click subscribe there, and while you're there, make sure you check out the description area where you can sign up for our email distribution list. In addition to that, we're heavy users of Twitter. Some of you that followed me over the weekend probably saw a ton of tweets coming from me on Saturday regarding my thoughts about Berkshire Hathaway, which, boy oh boy, wasn't expecting what we got. So if you're interested in my take there, feel free to check out my Twitter feed. My handle is @BrandonVanZ. And then lastly, we do also have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's jump into our charts. As you can see, I've got chart 4B pulled up here in front of us. And as I mentioned in the intro, the S&P 500 was up 0.9% today, so relatively quiet day. Remember, when you look at these labels here that say daily range in them, they will either be colored light blue or orange. And if they're light blue, like all of them are today, that basically means that we had a quieter day today than we typically would. That basically is a way for us to kind of gauge what's been going on with the range in the more recent trading time period that we've had in recent weeks. And so in all of our four charts cases, our range was considerably more quiet than it typically had been. And just one example here that I'm pointing at with the Dow Jones, our range today was only 300 points. The average true range in recent trading has been 725 points, so less than half of the typical range. So in other words, a fairly quiet day. But for the bulls, that's probably a promising sign. After all, this market has had its opportunities to sell off in a big way and kind of get us back into that mindset of where we were in March, and it just hasn't occurred. And so as you can see here with the charts, we look at all of them. They all have the dark green background color telling us that we have strongly bullish postures according to the market forecast intermediate line. Now, one thing I did want to point out on that is you'll notice down here in the lower right-hand corner with the Russell 2000, we are in jeopardy of losing our strongly bullish posture there. Notice that the intermediate line is at 80.46 and falling. Remember, if that line goes below 80, then the background color of this chart will start turning to pink. So we'll want to keep our eye on that. And remember, the Russell 2000 has been kind of out of sync to a degree with the other markets. It does kind of dance to its own tune, so to speak. And it has more times than not in recent months and years been a laggard compared to the other large cap indices out there, particularly those that are controlled by some of your mega cap tech stocks. You can see here the NASDAQ composite today was up over 1%. It was up 1.13%. And while this is the full NASDAQ composite here, you might also be hearing in the financial media that the QQQ, or the NASDAQ 100, so the largest companies on the NASDAQ that are not financial companies, we're within just a couple of percent of all-time highs, or at least yearly highs in the QQQ right now. So technology continues to be a leader in this market environment. Maybe that would be actually a good segue for me to pop on over here to the internet quickly and show you kind of the results of the sector selector that I put together on Friday evenings after having a full week's worth of data. And as you can see here, we do have a new king up at the top. It is technology. And so for those of you that have been holding firm to some of your big time performers out there, your Microsofts come to mind, and some of those software as a service stocks and cloud software stocks, all of those have been holding up reasonably well. So technology is back on top. Healthcare slipped from number 1 down to number 2, and then we had communications rising into the top 3 for the first time since going back to late February. Now remember, communications is a little bit of a different type of sector these days. For those of you that have followed the transition of sectors over the years, you'll know that there used to really be just 9 sectors. And then they basically kicked the REITs out of the financials to create their own real estate sector. And then after that, there was a couple of other transitions that took place as well. One of them was that telecom is no longer a sector on its own. Instead, it's been somewhat replaced by communications more broadly, and that pulled in a bunch of the internet stocks, including stocks like Facebook and Alphabet and Netflix and those types of companies. So these days, communications is going to act a lot more like technology than the old telecom did. In fact, the old telecom probably would have been a closer cousin to the utilities. It is true that AT&T and Verizon are still part of the communications sector, but because Facebook is a much larger company and because Alphabet is a much larger company, they're going to have a more influential role there. So you can kind of think of communications these days as being a little bit more akin to technology, and you are starting to see that kind of play out a little bit here at the top of my rankings. At the bottom, you'll see that financials continue to struggle. We heard a lot of that this weekend with the Berkshire Hathaway meeting. Of course, Warren Buffett runs a financial conglomerate, largely controlled with a bunch of insurance companies, so he's certainly no stranger to that, in addition to some of the airline news that he made in terms of some moves he's been making there. But what I wanted to point out while I'm down here in the lower half of the rankings is just to mention that energy continues to hold its own. You can see energy has made it all the way up to the number 8th slot right now. And that is fairly rare. I would have to go back in my records to check the last time it was ranked as high as 8 or better, but I can tell you it's been many, many months, if not a couple of years. So anyway, energy, after spending all this time dead last here for months and months, even going beyond this graphic, because this just tracks the last 3 months here, but even beyond this graphic, energy was dead last for as long as you can remember. And now all of a sudden, you're actually seeing legitimate progress taking place, where energy went from 11th to 10th, and then from 10th to 9th, spent an extra week there at 9th, and then this past week went up to 8th. So we're starting to see some progress there. In fact, natural gas is starting to catch my eye as well. And there's a couple of stocks that are starting to look somewhat interesting there, Cabot Oil and Gas, and then CNX. So Cabot Oil and Gas would be COG is a ticker symbol, and then CNX is, of course, CNX. But those natural gas-related stocks are actually looking pretty firm on the chart, at least compared to what we had been accustomed to with most energy-related stocks in recent years. So keep your eye on that trend. Obviously it's got a lot of work to do to get back into the favor in a lot of people's eyes, but at least you're starting to see some promise coming off of the bottom there. While I'm over here, I'd also point out that materials had a decent week as well. Materials went from number 8 last week all the way up to number 5 on the rankings this week. Now, they were ranked 5th over here in kind of the second week of April as well, but it's somewhat of a similar story to energy in that we haven't really seen the rankings of materials all that high. Back here, you can see during the kind of the February time period that materials was second to last, second only to energy at that time. So materials and energy have both been working their ways up the ranking system, and that's generally perceived as a healthy sign for the market, because those are a little bit more cyclical areas. And so we'll keep our eye on those trends and see if we can maybe take advantage of those. In fact, I'll be talking about the materials a little bit more so as we head into our trade application example a little bit later in the video. Let's get back on track with some of the Thinkorswim charts, and let me pop on over there. There we go. Let's go ahead and take a look now at what's been going on with the 3 green arrows setup. And so that will be chart 4. Where are we at? losing my spot. There we are, 4D, for those of you that are premium members following along at home. Now, as you can see here, we actually don't have 3 green arrow signals, and we don't have any 3 red arrow signals. We have a mix in all 4 of these charts cases. And the culprit on all 4 of the charts, actually, I take that back. I was about ready to say the culprit is the MACD, but for the Russell 2000, it's not. For the Russell 2000, the culprit is actually the stochastic. On the other 3 charts, you do have the MACD being the issue, including that outperforming NASDAQ composite down there. So the NASDAQ appears to be the one that's closest to going back to 3 green arrows. It would just need another little burst higher here in price to get that MACD histogram back above the 0 line, and it really wouldn't take much if we can get those tech stocks to continue to rally as they have been in the last couple of months. But otherwise, we do have a little bit of deterioration there, just a loss of momentum, and for those of you that, have the phrase price is king and it's the only thing, the price is still holding up, right? We're still above a rising moving average here. So for the most part, the trends are holding. It's just that some of the momentum is starting to fall by the wayside, or at least that is the assumption there by looking at the MACD histogram giving us those red arrows. So right now, I guess in summary, it's a mixed bag. You've got a little bit of bullishness and a little bit of bearishness, and they're trying to squabble with one another to see who's going to win out this little battle here. But right now, the path of least resistance does continue to be to the upside. As you can see, all 4 of those charts have green moving averages, signifying price above a rising moving average. In terms of our 1040 crossover method now, just take a look at where things stand, particularly with the NASDAQ, because this is what I brought up last week in one of my videos with you guys, was my expectation that the NASDAQ composite would end up having a bullish crossover, and it does appear that is either the case last week or it is the case right now. And we'll just have to see where this lands. But you can kind of see down below in the lower left-hand corner, the NASDAQ composite, you have this purple line that's just slightly above this black horizontal line, telling us that the 10-week moving average is slightly above the 40-week moving average on the chart here. So as it stands right now, we do have a bullish crossover. And remember, it's fairly rare to find moves on this particular chart setup on 4C here, because we're looking at 3 years worth of data for each one of these charts, and the 2 lines are representing a 10-week moving average and a 40-week moving average. Those are not the types of things that move quickly or start making bullish or bearish signals, as we would call them on this chart, very often. In fact, you can see that for a large portion of these charts, if you were to look up here at the S&P 500, we were just bullish that entire time period, and that stretched out for over 2 years, where you could have come in here and looked at these charts for 2 years and there would not have been a posture change. So I'm just trying to point out how rare it is for us to actually have something legitimate to talk about with this particular setup here. And the NASDAQ, as we've been kind of mentioning over the recent weeks, is the leader. And this is one more way to identify that, by saying, okay, well, the NASDAQ composite is switching to a bullish crossover or a golden cross on the 1040 crossover method, and the other 3 charts have yet to do that. In fact, the other 3 charts have a long ways to go. It's not even close at this point, right? You're looking at significant separation between the blue and the orange moving average here, significant separation here, and significant separation here. So it really is a market that's being led by the more growth-oriented, biotech stocks and other technology-related stocks that would be prominent within the NASDAQ composite itself. All right, let's go ahead, take a look here at some 12 grid analysis now, starting off with the asset class 12 grid. So this will be chart 5A for those of you that are following along at home, and remember that the background color of these 12 grids will signify whether the current posture is bullish or bearish according to the market forecast intermediate line. And you can see here we have more green charts on this initial 12 grid here than red charts, but there is a healthy mix between all of them. And on the bottom rung, we continue to have those 3 out of the 4 that I talked about last week that are still in the kind of the bearish zone or the bearish posture area, and that is the US dollar in the lower left-hand corner, oil second to the right, and then the US Treasury yields all the way in the lower right-hand corner. Now, the oddball there is gold, and this is kind of what I was referencing in the intro, and where we are going to focus on a trade application a little bit later. You guys know, if you've been listening to these presentations, my enthusiasm around gold in the last several weeks, if not months. And I still think there is room to run in gold and gold-related instruments. In fact, we still have our bull-put spread going on the junior gold miners. That's working out just fine for us. I also have a position in GLD itself in this particular paper money portfolio, and a position in GFI from a long time ago that still hasn't been stopped out, which is a South African gold miner. So sneak peek to our trade application example a little bit later in the video will be a bullish trade on a gold mining stock. But before we get there, let's talk about some of these other charts. And as you can see, we have some decent looking bounces here on the top rung when it comes to various stock markets, whether it's the U.S. market, EFA, which is the developed foreign stocks, or emerging foreign stocks here, EEM. All of them kind of pulled back over the last week, and then today bounced a bit higher. It was the US that led the way, up nearly 1%, but all of them kind of have that same look to them where they pulled back close to that rising moving average and then popped higher here today. So hopefully that's a good sign for those of you that want to be bullish, that maybe that was an opportunity for something like a bull flag that is about to break out if it can continue that bounce going forward here. Let's go ahead and take a look at our sectors. Talked about this a little bit already with our sector selector analysis, but let's take a look at it from the 12 grid perspective here as well. And you can see here, it's a little bit more of a mixed bag than it was last week when I reviewed this with you. Last week we had pretty much a clean sweep with green charts. Now we're starting to see a few more of those pink charts show up, including the financials, which I mentioned before on the sector selector was dead last in my rankings over the weekend, so that one makes sense to me. Down below, you're starting to see those interest rate sensitive areas struggling on a relative basis. So you've got the consumer staples right here, which have been kind of languishing. Now, the exception to that is Clorox, which I had brought up in these sessions here last week. Clorox did report their earnings on Friday, and it did go up as expected. They had a blowout number in terms of their earnings, and then the stock responded as well. So Clorox is kind of one of those trend trades. In fact, that is an actual trend trade we have in my top-down trend trading class for my Monday trading room I do for my premium members. So we're happy to see this because this has been a trending stock for quite a long time, and it continues to go higher. And you can see this nice move here that we've had over the past week with Clorox. So that's kind of an exception to the rule there. For the most part, the other consumer staples have kind of just been taking a back seat now that the stock market is really bullish again. There's a lot more exciting stocks out there than consumer staples. So I don't necessarily think it's anything terrible against the staples. It's just that market participants are willing to take on a little bit more risk right now. And that's probably the same story with utilities and REITs as well. REITs, I think there is an underlying concern that there may be some dividend cuts on the horizon. After all, if Disney can cut its dividend like it did tonight, then many of these REITs are probably going to have to consider cutting their dividends as well, considering 1 out of every 3 people that pay rent apparently didn't pay their rent last month in some statistics. I don't know if that's entirely accurate for businesses as well, so I'm sure there are some areas of real estate that are doing better than others. But the point is, people have kind of used this COVID-19 as an excuse not to pay their rent, and that could come down and hurt the real estate investment trusts out there. So we'll keep our eye on that story, but I think the bigger takeaway here is that this has been a more robust risk-on type of a stock market, and market participants are kind of trying to push their money into more cyclical areas as opposed to non-cyclical areas there. Again, you will notice right here that materials is one of those areas that continues to have that dark green background color. Its intermediate line is in the upper reversal zone above 80, so this would be considered a strongly bullish posture on materials. And the reason I'm bringing that up is, of course, gold mining stocks are part of the materials sector itself. Let's go ahead and take a look now at the commodities 12 grid. This one we don't always look at, but I did want to kind of point out what I mentioned earlier in the presentation, which is we're starting to see some more positive developments with some commodities. Not all of them, obviously, but there are some interesting things that are starting to develop. One of them I mentioned specifically before was natural gas, and there's been a little bit more chatter on financial Twitter about this as well. In fact, I retweeted something about natural gas earlier today. So there's a few more eyeballs showing up on natural gas. This is UNG here. Remember, if you wanted to look at the natural gas futures contracts themselves, you could just type in /NG to kind of gauge that a little bit. But you can see the same type of pattern. That's a fairly strong saucer or cup-shaped base that's being formed there. And, this is not just a quick little jut higher and then right back down. This has been carving out a series of higher highs and higher lows really since, the middle of March right there. So that's something that probably would not be expected if you ask the average person on the street that just picks up a copy of the USA Today and reads that oil prices were, so out of favor that they were negative at one point here a couple of weeks ago. They would probably assume that natural gas is getting hammered as well, and it's just simply not. Natural gas is actually up 12% in the last 3 months. So there could be some opportunities there, and I mentioned those ticker symbols before, CNX and COG, as a couple of stocks that would benefit supposedly if natural gas prices continue to rise. And I almost went with one of those as our trade application tonight before I saw the gold mining chart that I wanted to focus on. So anyway, I'll keep my eyes on those as well, and perhaps I'll end up doing a bullish trade on one of those in an upcoming presentation. But did want to point that out because it's not getting a tremendous amount of buzz out there, and I want to make sure that when you guys watch these presentations, you're having some healthy takeaways from the presentations that you might not have known otherwise. So keep your eye on natural gas. There is something brewing there. And then you can also see gasoline made a nice little move here today as well. And that might be a little bit of a surprise, considering, again, oil prices have largely been in the news for all the wrong reasons recently. And you might be assuming that, not a lot of people are buying gas, but all of a sudden we had a nice little pop higher there in in regular gasoline. And that brings us all the way back here to probably mid-March as well in terms of a high point from there. In fact, I noticed a couple of those refining companies like Phillips 66, so ticker symbol PSX, there you can see actually put in an overbought cluster signal today. It's been a long time. You can see all these oversold cluster signals over here, but Phillips 66 has had such a nice move off the bottom that it now actually has an overbought cluster signal. And remember, the overbought and oversold cluster signals within the S&P 500, like Phillips 66, is sent to you guys every day in your email. So when you check the email here from me today, if you're on our email distribution list, you'll see Phillips 66 as one of those ticker symbols on there. So keep your eyes on those lists, and if you're not part of our email distribution list yet, make sure you're doing that. Like I say every time I do this presentation, at the beginning in my intro, you can find the sign up for the email distribution list in the description area directly below the YouTube video. All right, so that's kind of what I wanted to chat about there. And again, we talked about this already, but just recognize here that gold continues to be trending higher and higher. So that gives us a nice little segue into our trade application example here. And for that, I wanted to talk about basically the only gold mining company in the S&P 500, and that is Newmont Mining. Gold mining industry has been kind of shattered over the years, and there's just not a lot of major publicly traded players left. And a lot of them that are still around are, foreign companies like the GFI that I mentioned before that we have a position in still. Our stop loss is going to be way down here, but we still have this trade going. This one's based in South Africa, but you have others like BVN that will be based down in South America. You have others like Barrick Gold that's up in Canada. So the point is, you have a small amount of companies out there that are considered legitimate, gold mining entities, and very few of them are headquartered in the United States. One of them is Newmont Mining. So if you're a big institutional money manager, you're going to have a hard time in some cases, locking down a company that's liquid enough there where you could put in tens of millions, if not hundreds of millions of dollars worth of your client's assets into it. And so Newmont would be one of the very few that major money managers could probably consider. And so as you can see, Newmont Mining here today had a heck of a day. First of all, it reported its earnings here this morning before the bell, and then you can see where we ended the day. We ended at a new multi-month high here, and we closed near the high of the session, so a very good sign. This was actually the third straight day of bounce there for Newmont, but what we have today as opposed to yesterday or the day before would be the knowledge that earnings are not going to torpedo this stock. Now, it doesn't mean that this stock can't go down. It can certainly go down for other reasons. It's just that we now have sidestepped a potential landmine there with, the earnings out and everybody having, interpreted it and kind of absorbed it and are willing to send the stock price, in this case, higher. So what we're going to do tonight is going to be a little bit of a different type of a trade setup than I typically will show you. So I'm going to come over here to the trade tab, and I've already got it loaded up down at the bottom. What I'm going to do is it's a diagonal spread, and it's a long diagonal spread or a debit spread in this case. And the strikes that I've selected are going to be a little bit different. So let me kind of explain. First of all, my long strike. Let's talk about that first. My long strike, I'm coming all the way out here to... Hang on a second. I'm losing my place. There it is. So we're out here to the January 2022 leaps. These are the ones with 626 days left. These are the longest ones out on the Thinkorswim platform. So we're talking about being in this trade for, upwards of a year and a half. So if you're going to do a trade like this, first of all, you have to have kind of a bullish mindset towards gold going forward. Obviously, if you think gold is going to get annihilated in the coming months or years, you're probably not going to want to do a trade like this. On the other hand, if you think that gold can continue to work in an environment where we're still struggling with the coronavirus and the government is pumping as much money into the system to keep the economy stable as they can, we might have an inflationary era, and that could very well benefit gold. It certainly seems to have done that so far in at least the recent weeks. And so this will take us out a long period of time where we don't have to necessarily buy 100 shares of Newmont Mining. Instead, we could buy a call option to kind of replace that longer term view towards this gold mining company. And of course, the reason you would want to do that is you're going to spend a lot less money buying a long call option than you would buying 100 shares of the stock outright. If you bought the 100 shares of the stock outright, you'd spend about $6,500 on that right now because it's about a $65 stock. So what I've done instead is I looked for the 70 delta in those call contracts that expire in 626 days. And in this case, that leads us to the $55 call option. Now you can see here that there's about 677 contracts in the open interest. The other two surrounding it actually are in the 2000s area, so 50 and 60 strikes are a little bit more liquid for those of you that are looking for that sort of thing. But, there's at least some interest in there. If you look at a lot of stocks that have these contracts available out to January of 2022, many of them don't have very much trading whatsoever. This one actually had somebody trading it today. It was only one contract, but at least gives us a little bit of price discovery. That was traded at $18.13 here today. And if you think about it, for those of you that are newer to the idea of buying a call option, you can kind of gauge what your break even would be. So $18.13. Let's say we could get filled at that price. That was the last traded price that was affected today, so we might be able to get filled at that tomorrow. So $18.13 plus the strike price in this case of $55 even. That means that our break even is 73.13. So you have to have a bullish posture here, because if Newmont Mining is not going to go above $73 in the next year and a half, this is a trade that's probably not going to work out for you. So again, that's where the difference is. If you bought 100 shares of Newmont Mining right now and spent $6,500, and that stock was exactly at $65 in January of 2022, you didn't make any money, but you didn't lose any money either. If you bought this call option and it stayed at $65, you're going to lose your full premium, which in this case would be about $1,800, right? $18.13 on a contract translates into about $1,800 is what you're actually paying out of your pocket. So it really comes down to your perspective. In this case, yes, you're only paying $1,800 to control 100 shares of stock, which is better than spending $6,500 to do it in the stock market right now, but you have an easier ability to throw that $1,800 completely away if the stock does not do what you need it to do, which in this case is go higher. So that's where the second part of our conversation comes in, which is, as you can see down below, as I mentioned before, I've got a diagonal spread set up here. And the other contract that's involved, you can see I'm +1 down here of the, or I'm sorry, -1. Apologies, -1 of the $75 call in June. And this is the one that'll expire here just next month. So what I'm doing is I'm trying to offset the cost to a degree of the long call. And in this case, I can get it down to about $17.13 because, again, this contract, the long one, was going for $18.13. This trade, if I were to get it executed at this price as it's set up right now, says I only have to pay $17.13, not $18.13. So you might be wondering, well, where's that extra dollar coming from? How come you don't have to pay $18.13? How come you only have to pay $17.13? And that's where selling the 75 call in June comes into the conversation. So let's go take a look at that as well, just to make sure you're on the right track here. And as I look at the June contracts here that expire in 45 days, you'll notice that the $75 call is trading for basically $1 right now. It closed out today's session at $1.01. So basically what's happening is you're selling the 75 in the near term to generate a little bit of income to offset the cost of the long call that goes out to January of 2022 by a full $1. Now, that's all fine and well if Newmont Mining doesn't go above 75. If it does go above 75, you will continue to benefit from your ownership of the $55 call, but you will start to see potential paper losses on your 75 short call in this particular case. It's one that you would have to kind of monitor as you head into the June expiration period there. But, you know, if this gradually went up from, let's say where it's at right now, $65 to, let's call it like $73, and again, here's a look at the chart. 75 is up here kind of in the exact right-hand corner there. So if this kind of gradually started meandering higher but didn't quite go above 75 here, then what's going to happen is that 75 short call is going to expire worthless. In other words, you would capture all $1 of that premium, and you would still have an ever appreciating $55 call that you are long that you could then again sell another call against in, let's say, the month of July or in August or in September, or doing that over and over repetitively for the next year and a half if you could get away with it while you are the owner of the long call leaps in this case. Okay, so a little bit of a different trade setup there, but hopefully most of you that are understanding of options kind of get the gist of what I'm hoping to accomplish in this bullish trade setup that we've got working here. So let me go ahead and click confirm and send and ship that off, and we'll get we'll see if we can get filled on that tomorrow. I did put it in as a good till cancel order, so if it doesn't get filled tomorrow, I will be willing to get filled on it, for the rest of this week or next week or what have you. And that might be wise in this case, considering, we're looking at those long call leaps out there a year and a half. They're not the most liquid thing on the planet, and so it might take you a few days to work your order there. But hopefully that gives you at least one idea of a way that you can try to take advantage of this bullish theme of gold that we've been talking about incessantly for the last several weeks, and it continues to work for traders and investors out there. So with that, I want to wish you all the best of success with your trades and your investments. Remember, David will be back with you tomorrow. If you got value out of the video tonight, learning about the strength in natural gas, or learning about the dividend cut at Disney, or learning about the continued upward trajectory of gold and gold miners, be sure to go over to Twitter and click like for me there. That's what David and I use to try to gauge our success with these free YouTube videos. So if you do have a Twitter account, we really appreciate that. Thanks so much. Have yourself a great rest of the day, and we'll see you all later. Take care. Bye-bye.